Good evening and welcome to Atlantic Federal Credit Union's Credit Score Seminar. Our goal tonight is to help you unravel the mystery behind your credit score and to provide you with the knowledge to take control of your financial future. My name is Leah Villasis, and I am one of the consumer lending managers here at the credit union. And I'm also joined by Emily Hamilton, who is the Vice President of Consumer and Mortgage Lending. As we go through the presentation tonight, if you have any questions, you may click on the Ask a Question button to submit those, and we'll take some time at the end to answer as many as possible. So with that, let's get started. Where does a credit score even come from? Well, there are three major credit reporting agencies or bureaus, which are known as Experian, TransUnion, and Equifax. Each individual bureau uses their own unique formula to create a credit score. This often can be the reason you may have a different score depending on where it's coming from. Each individual lender or financial institution is able to choose the agency that they prefer. While all lenders and financial institutions rely on the information from credit reports and your score to decision a loan, the way we lend or look at loans here at Atlantic is a little bit different, and I'm going to touch on that later on. Within each bureau, there are multiple different scoring models. TransUnion, for example, has over 10 different models. For this reason, you may find that institutions or lenders will provide different scores, even though they may be using the same agency or bureau. The most common scoring models you'll hear about are FICO scores or a Vantage score. Here at Atlantic, we use the Vantage scoring model. Now, your credit report is made up of different types of accounts or what are typically known as trade lines. And your trade lines are split into two different categories, revolving loans and installment loans. An example of a revolving loan would be a credit card, line of credit, or home equity line of credit. These accounts or trade lines don't always have an end date, and the monthly payment amount can vary. You can borrow from them and pay them down to be used again and again. An example of an installment loan would be a mortgage, home equity loan, auto loan, student loan, or even a personal loan. These loans have a specific start and end date and a set monthly payment. Accounts that are not paid at all or accounts that are paid late are considered to be derogatory accounts. If you have a bill or a loan that is sent to a collection agency, it's considered derogatory. Repossessions and bankruptcies will also report negatively as derogatory accounts. We've talked so far about the different credit reporting agencies as well as what type of accounts or trade lines that are reported. Now let's look at some items that don't typically show up on your credit report. Items such as utility bills, rental, lease payments, cell phone and insurance bills, these won't report as trade lines even if you pay on them perfectly. Those same items, however, can show up as derogatory accounts if they're not paid and sent to collection agencies. While these items don't help to increase your score, they can certainly cause a decrease in the score if they're not paid. Once you have a few accounts or trade lines opened, your actual score is compiled of a few different things. Now, depending on which model is being used, whether that's a FICO or a Vantage, the weight of these will differ slightly. First, we're going to take a look at FICO scores. You can see on the pie chart that your payment history holds the most weight. This is relative to on-time payments versus late payments. Capacity, or how much of a balance you carry on your credit cards, makes up the second biggest bucket at 30% of your score. We're going to circle back on exactly what capacity means in a few moments. The type of credit, which would be a good mix of both those revolving and installment loans, will make up roughly 10% of your score. New credit, or newly opened accounts, will make up roughly 10% of your score. And lastly, your length of credit, or how long you have had credit history overall, makes up roughly 15% of your score. Now, when we look at a Vantage score, you're going to see some very similar trends. The biggest difference here is that there's a new bucket called current credit balances, and that will make up about 11% of your score. Now, back to capacity. Capacity makes up a big part of our credit scores. Capacity is about how much you have in total credit card limits. So, for example, if you had a credit card with a $1,000 limit and you spend $500, you've used half or 50% of your total capacity. What does that mean for your credit score? Well, you will lose about 50 points off of your score for using 50% of your total capacity. Now, if you had started with a 650 credit score, by spending that $500 on your $1,000 card, you could have dropped your score down to 600. The good news about capacity is that once you pay that balance back down, your score will quickly go back up those same 50 points. Paying down your credit card balances is the single fastest way to improve your credit score. So now that we know what's on a credit report and what your score is made up of, what does that score mean and what's considered to be a good score? Credit scores range from a low of 350 up to 850. Now, each lender may look at scores a bit differently, but generally speaking, a good score is considered anything 600 or higher. Credit scores of 730 and higher will most likely get you the best rates available. There are some key things to avoid when it comes to building credit. These items can cause your score to drop and sometimes drop fast. First, late payments can really do some damage. A single late payment can drop your score anywhere from 60 to 100 points, and those points can often take as long as 12 to 18 months to get back. Each hard inquiry, or a new opened or closed account, can drop your score about 4 to 7 points. Now, in regard to inquiries, there is a significant difference between what we call a soft pull and a hard pull. A soft pull is not associated with a lending decision, but can commonly be used by employers, insurance agencies, sometimes landlords, just to name a few, simply to review your credit. A soft inquiry does not affect your credit score. A hard inquiry, however, is an inquiry into your overall credit history to determine whether you manage your existing accounts responsibly. These can lower your credit score. Keeping your credit card balances high can also hurt. Like I mentioned before, you lose approximately 1 point for every percent of your card usage. With that said, though, credit cards are a necessary part of your credit score. But keep in mind, just because you have a credit card does not mean that you need to use it regularly or keep a balance on it. Lastly, repossessions. These are difficult for any lender or financial institution to ignore in a credit report. And many people don't realize that when your vehicle is repossessed, you still need to pay the remaining balance, even though you may no longer have the car. On the positive side of things, there are some things you can do to help increase your score. Paying down revolving lines or credit cards is the single fastest way to boost your credit score. Just like carrying a high balance on them will decrease your score, paying them down, preferably to zero, will help increase your score. Next, pay your bills on time, every time. By creating a monthly budget or setting up automatic payments, you can help ensure that your bills are paid on time. You'll also want to have a good mix of both revolving loans and installment loans. Ideally, a minimum of 4 different accounts or trade lines is best. And lastly, time. Building your score does take time, and what's most influential on your credit report is anything reporting within the last 2 years. Now, I want to take you through a real-world example of how your credit score can make all the difference. A good or even great credit score is more than just a number. It can literally save you thousands of dollars. So let's take a look at 2 members and how their credit score affects the way they each pay for a loan. Member A and member B are both shopping for the same exact vehicle priced at $25,000, and they're both looking at a 72-month term. The only difference between them is their credit scores. Member A has a credit score of 731, which qualifies them for an incredibly low rate of 2.5%. Member B has a credit score of 635, which is still considered to be a good score, but it qualifies them for a much higher rate of 11.24%. Now, what does that mean for the monthly payment? Member A has a payment of $374.31 a month, but member B will have to pay over $100 more a month for the same vehicle. Why? All because their credit score was lower. What's even more eye-opening is the interest that these two members will pay over time. With that low rate of 2.5%, member A will pay $1,980.15 in interest on their loan, while member B is paying over $9,400 for the same exact vehicle. That is the power of a credit score. Here at Atlantic, we want to help you do better and to help you save money. Our loan specialists can help you learn how to build and maintain your credit score so that you can pay less and get the best possible rates on all of your loans. When it comes to making a loan decision, we don't just look at a credit score. We want to hear the real life story. We want to know what happened and why. We understand that every story matters, and our mission is to change lives for the better. Here at Atlantic, we also offer a free financial checkup. You have the ability to reach out to our experts through Video Banking by Atlantic, applying online at our website, visiting any one of our 10 branches, or you can even speak with a loan specialist over the phone. You can keep an eye on what is currently reporting by signing up for Savvy Money through our digital banking by Atlantic, which can help you monitor your credit. Atlantic's goal is to help you do better. A better credit score will lead to better rates, which we believe will lead to a better future and a better life. This concludes our presentation. And at this time, if there are questions, we would love to open it up to answer as many as possible.
All right, thank you, Leah. I don't see any questions yet. Let's give it another minute here to see if anyone has any. It is a little bit delayed on their end. Were there any questions that had come in, Leah, that we looked at that you haven't answered already as part of the presentation?
I didn't see any questions at this time. Emily, did you have any?
There was one question that came in ahead of time, specifically regarding medical collections and their impact on credit and credit scores, which was a timely question because there have been quite a few changes in the industry regarding medical collections that might be worth mentioning. Over the last couple of years, there's been a couple of changes. One of those is that paid medical collections are no longer credit reportable. So they won't impact credit score and they fall off the credit report like they never happened, which is exciting because historically it hasn't made a lot of sense for consumers to pay medical collections. In many instances, it actually reduced their score further to pay them. So it kind of increases the incentive to pay those medical collections where they completely drop off the credit report. Another change that occurred more recently is that there are really two things that make a medical collection credit reportable. One is that they are over $500 in balance and they have been in collection status for a year. This means that it allows consumers to have more time to set up any kind of payment plan or payment arrangement with the medical collector. And it also saves the reportable medical collections for larger dollar amounts. And the only last thing I would mention about medical collections in particular with credit scores is there are several models that are no longer taking medical collections into account. The credit scoring model we use here at Atlantic is a VantageScore score, and that score does not actually use medical collections when determining the score. So those are all within the last 2 years that those changes have occurred, and may be applicable to some of the people attending tonight.
Okay, either Leah or Emily, we do have a question that came in from Cynthia. She said, so getting a loan will improve my credit?
Do you want me to pass that back to you, Leah?
I can take it, sure. Cynthia, that is a great question. If you're looking to build your credit, absolutely. We had talked about in the presentation that inquiries into your credit can drop your score as well as opening new trade lines. So getting a new loan absolutely is most likely going to start with that negative hit on your credit. But over time, that good payment history, that is what's going to help build your credit. If you don't have loans reporting or you don't have a score, Atlantic does offer some great options to our members who are looking to build credit. Specifically, we have a credit builder loan and also a secured credit card. Both of those products can be really beneficial for our members that are looking to build credit.
So to add on to that, Cynthia said, seems like adding debt would be a negative thing.
Yes, it can seem scary a little bit, but it's definitely one of the ways that you can build credit. A lot of times, similarly, we hear members that don't want to take out credit cards because they think that it will affect them negatively. And there are times that that can, but credit cards are a pretty big part of your credit score and can help to build it as long as you're using them the right way. And that's something that our loan specialists here at Atlantic can help educate and help you understand how to do that. So it does impact you in a positive way. Great question.
There's another one here. It says, can Credit Karma or the like really do anything to help a credit score?
That's another great question. Places like Credit Karma, there's a few different ones that are very similar. Atlantic even has a credit monitoring platform as well called Savvy Money. Many of those places can be really beneficial to monitor what's on your credit. Again, some of the best ways to build credit are through making on-time payments, having the mix of types of loans, those installment versus revolving, keeping low balances on your credit, and just making payments on time. Those are going to be the best ways to improve. Some of those sites, again, more are for monitoring, not necessarily helping to build your credit.
Yes, I know for personal experience, my husband noticed credit monitoring something that wasn't actually his. So it's a great way to help prevent fraud as well. Another question that came in, if you have a vehicle repossessed and subsequently go through bankruptcy, will you still need to pay on the vehicle?
That's a great question. I'm going to pass that one over to Emily. I think she's got a great answer for you.
It is a great question, and it definitely depends on that particular situation, what's included in the bankruptcy itself. And I'd honestly refer that one over to a bankruptcy attorney to look at that particular scenario, because you can include certain debts through bankruptcy. And it could leave obligations that are still owed, and it could leave some that are absolved as well. So probably not the best to provide that specific advice.
Okay, I'm not seeing any other new questions that have come in. So I think we can wrap things up, Leah, if you would like.
Yes, I want to thank you all for attending. Hopefully you found this beneficial. I believe you'll get a follow-up with a link to the recording. So if you'd like to play any of it back, you're welcome to do so. And one of the slides does give you multiple ways to reach us. We are happy to help. Oh, Robin's got it right up on there for us. We're really happy to help. That's our mission, is to help our members do better. So look forward to working with some of you in the future. Have a great evening.